part of my family. This is great. It's again, I mention every week that I look forward to this, and I really enjoy being with you. Uh, the markets have not been dull, so it even makes it more interesting. It's almost like a soap opera now. So I look forward to following week what's going to happen. And thank you for joining us on Wednesday. I hope it was informative. I like to continue doing that. Have at least once a week, and it seems like for most of American audience, it's a better time, middle of the week. It's after 5, so it's a little more flexibility. So I like to do that. This past week, we worked on the selling discipline and the art of selling, and I appreciate some of the positive feedbacks I got. As I had mentioned before, if you go and search on YouTube, you hardly find anything concrete about selling discipline. You might get 5 or 10-minute clips, but nothing comprehensive. So it was just the outline of things to look forward to as far as what to look as far as selling goes, and which we will have more in depth. And we will continue that. And this week, what I like to do, if with you, I like to go to the foundation and the foundation of investing, and actually work on what is a good sample of trading plan. Because without a trading plan or a business model, without your journal, everything else is more of a technical, quantitative knowledge, but it doesn't take your goals into the account and basically what you need to do to be a successful investor and trader. Having said that, let me start with this because it is, as you know, I like Warren Buffett. I love his sayings, and Charles Munger even more. The best investment you can make is an investment in yourself. The more you learn, the more you'll earn. Now, I understand sometimes it's very difficult in the beginning, and that's, again, my whole mission is not giving you stock tips or investment tips and hoping that you will have one-time winner or maybe learn from one experience. The whole idea is to allow you to earn the knowledge internally, and it's something that will stay with you rest of your life. And that's the way of, I think, being able to be a successful investor and trader, and hopefully profitable one. And the other thing is, again, in this situation, you are becoming proactive. And by learning these, there's an old saying, discipline is important, but discipline comes from confidence, not the vice versa, at least in my experience. Once you're confident, you become even more disciplined, and that's where the good habits continue, and that's how you become more successful. So this week, what I like to do, we're gonna, as usual, like to just for a few minutes talk about the economy. We do a few minutes on the markets. I'm briefly gonna just talk about the trade of the week and tie that in with the strategy of the week, and spend a little more time on the question of the week, which could bring a little more depth understanding of the subjects we've talked in the past. And then we will end our meeting with the ETF of the week and just talk about the expected move. There are not many earnings major earnings are coming up, so we'll just talk about expected move. So the economy, it was something we were, obviously, it was the first Friday of the month. Every first Friday of the month, the employment numbers come, the non-farm payroll, the jobless and the job numbers, and the markets were looking forward to that. And it kind of was like a fizzle in a sense. I mean, not much movement, but there's a lot of other things that are happening. What the idea was with the jobless numbers, and when they come, they if they were really bad, then the Fed is going to be proactive. The fiscal side will be proactive, so the market would have gone up. And if it was really good, then say, oh, good, the economy is moving. So it was kind of in between, although it supposedly beat the expectations, but it was slowed down compared to numbers from May and as well as from May, June. Again, this is our weekly our weekly routine, and again, I emphasize on these. Year to year, you can see there's still big question marks with the initial jobless claims and continuing jobless claims. We are, the level is at 16 million, and we're looking at last week we had 1.692 million of jobless claims. So, I mean, a year ago, last week we had 1.1 million. But I think this is interesting. Again, it gives us the real life, what is happening. As you know, in a hotel occupancy, if you talk to a lot of people, they still, especially families, they're not going out, they're not going to concerts, they're not going to the games, even though the games are on, but it is weird to see empty stadiums. So the markets are becoming, technology is becoming a little more innovative. They like to have live shows and people can kind of get involved from their home, but it's not the same feeling. So let's talk about the banks. The financials had a good end for the week. And what is happening with the major banks, they are really using their capital structure to have a big backing for their loan losses. And we go back from the first quarter where we were, what they have done the second quarter, because obviously they're expecting a lot of defaults, so they just want to protect themselves. And I've mentioned before, again, the banks are in much stronger position than they were in 2008, so 2008, 2009. So they're trying to protect themselves, and by doing that, I don't know if still enough. I think they're going to do even more. One thing I want to emphasize today is basically, although they have put a lot of extra capital aside, they're really tightening their standards for the loans, especially small firms when they need it the most. And it also applies to individuals. So this is something we have to be wary of. Although it helps the banks, for small businesses is not helpful when you really need, this is the time to have access to the capital from the banks. And that's where like the SBA loans come into pictures. The SBA loan right now, they are backed, and the banks, when they use SBA loans, are backed 85% by the government. Now they're asking for 90, and I won't be surprised they want 100%. That means they really want to have no risk. And so we'll see how the fiscal side will do, but that's kind of amazing. They're in the business of risk, in a sense, to help businesses, and yet they're not willing to take any chances. So I want to tie this in with even the personal lines of credit for individuals who use like credit cards. They have a very good scores, FICO scores, over 800. What the banks are doing, they're actually looking at people who have a great credit scores on a negative side. And the reason for being is a lot of, again, people who don't have debts, they have a very good scores, they actually risk in a sense that they have a potential usage of that credit card. What I mean by that, let's say somebody has a $50,000 line of credit, has a zero balance. The way the bank looks at it doesn't look at that zero balance. It looks at it, well, this person, first of all, is not using it. So what that means is there's no fees coming in. There's no interest charges. And what is happening, there's a potential this person can come anytime and use $50,000 line of credit. And not to pay it back. So what they are looking at is a chance of loss. On the other hand, there are people who use their credit cards, maybe they had 3 or 4, they paid on a monthly basis, maybe they even paid up, but because they're using, at least they are paying fees, they're becoming profitable for the bank. So banks are favoring people who have usage of credit cards than people who have zero balances, great scores. And that's interesting about businesses too. So some businesses have done very well, and they might get even punished for that. And I know, for instance, personally, like, I have this couple of cards that I use. I use the Costco because of everyone else does. We need to use it. So the Citibank, and also I use Capital One because I earn points. This has the lowest interest rate if I ever need it. So other than that, I don't use any other card. So basically, that's for the convenience. So this is just how the banks are looking at credit risk. The other part is I want to talk about the employment. The employment, it looks like that what has happened, the numbers came at 1.74 million, which was, again, supposed to be 1.4 million employment, even though it was lower than that 4.4, 4.5, and 2.5 million. It still shows that there is a momentum, especially in the hospitality. There was improvement. But some reason the numbers don't jive. And what happens is that the unemployment went down to 10.2%, which is still very high. When you look at the employment or the workforce, is about 160 million in the United States. You multiply 160 million times 10.2%, approximately about 1.61 million, 16.1 million unemployed, which is very, very high. I mean, imagine where we were, the best numbers in January, a little over 3%, the best in 50 years, and here we are the worst. So, but when you look at these unemployment numbers, and we look at that the continuing, even though we had a little improvement, we had about 31.3 million. This is from the Mishtalk source, by the way. So when I divide 31.3 million, these are the people who are, obviously, they're getting unemployment checks. If I divide 31.3 by 160 million, we're close to almost 20%, about 19.2%. So there's a big difference between 10.2 and 19%. And this doesn't include people who are not eligible. A lot of self-employed people don't get unemployment. So there is, again, a dichotomy of two economies and numbers. And I'm not saying numbers are cooked, but I just want to be more realistic as what's going on. Now, again, in the past, we've said, the economy is completely separated from the markets. So that in mind, let's see the week that we had in the markets and what happened. It was a good week for the Dow Jones Industrial, and we'll discuss what happened in the markets and what is going on. You will see there's some type of a rotation. So the best performing was the small caps and the Dow Jones Industrial. They were up 3.8%. The S&P was up 2.45%. The NASDAQ was up 2.47%. And this is Barron's, which is up 3.33%. Now, what had happened, you can see the Dow Jones Transportation was up nicely, 5.8%. And we go back to small caps, were stellar, and I will explain what happened to that one. They were up 5.35%. Now, on the other hand, the week earlier, the advanced declining lines were at 17 to 13, but last week we had, again, the widening, broadening participation. The dollar was pretty flat, and what happened was the gold, obviously, it did go through that 2,000 magic number. I think it hit 2,081 or so, and it had needed a little rest. It corrected itself a little bit, and basically the bond market also had a little movement. Friday they had a little sell-off, but it was a positive week for the bonds as well. But again, looking at the sentiment, and we've talked about this a lot, the sentiment actually has gone a bit higher than last week. So there is optimism. Again, this started since May, and it will continue till it stops. But when it stops, it usually doesn't end pretty. And again, when you compare your notes to last week, I hope you look at your slides. You can see even the CNN's fear and greed, the 7 factors that they use, is higher than last week. Last week was 65, and we are now at 72. This is something from Macmillan, Lawrence Macmillan. He looked at what is the put-call ratio, the equity only. This is where the markets are, and this is where the put-call ratio is. That means the volume of number of puts to the volume number of calls. And this is from the lowest, and then he goes and he tweeted that the only equity only put-call ratio is at the new lows for this move, which means that they're still on the buy signals because there's enthusiasms and the money's still coming in, but they're extremely overbought. And what has happened, the standard ratio this is the lowest since 2004, and then he applies it to S&P 500. So the difference is the equity only takes all the stocks, and then this is for the index S&P 500. So what happened last week? As I mentioned, the Russell 2000 had small caps had a stellar week. We also saw Dow Jones had a pretty good week, and so they basically were better indexes. So what happened, this might explain. You can see, and it's been a little common theme, you see the best performers for past week were the industrials, financials, and energy. And now these are the ones who comprise most of the Russell 2000. So what you could see, you can see that technology was in between because of the, again, with the Apples of the world and the Facebooks of the world. They performed well, but there's a rotation, and the rotation has started, and this will continue. So you will see that the broadening is happening a little bit, but the fresh money is not coming to everything. Money moves from one sector to another sector. But when you look at the performance of year to date, you can see the energy is still underperforming, and financial is still down 17%, while you have the cyclicals and the technologies up 25%, and the consumer cyclicals are up 19%. I also look at Friday. Friday, let's see, it ended up positive day, but the NASDAQ was down. This is the NASDAQ 100, although it was 104. It takes some of them still there, part of the index. You could see there were 34 positives, and the rest, about 70, were in the red. This is something new. So just give you again a picture worth 1,000 words. So rather than going one by one, you can see that how we have behaved in the last 3 months. This is where the Dow Jones Industrial Average is. You can see a movement in S&P 500. NASDAQ stalling a little bit. Russell 2000 has started moving in the stronger one. This is the Nikkei and Euro stocks, the DAX of Germany. And then this is what's happening to volatility. And in one picture, I thought it would be easier to see what's happening with all the indexes. I also want to see what is happening with the S&P 500. We are very close to the peak that we were in before the sell-off, and we are not too far from that point on. So it's probably about 50 points, so it easily can happen. Also, precious metals, as you know, have been in the news, and we've been following it since I believe we did the class in April, the beginning of April, about gold and silver, and then we did one about 3 weeks ago. So what they are telling us, that with all the markets are concerned about long-term inflation and devaluation of dollar. So that, and as I've mentioned before, the central banks, they have decided that to leave the interest rates as low as possible. So again, with no yields, no competition, the money is going to gold, but also because there is that concern about the future. So this week we really needed a well-deserved break. Usually when we go above round numbers, which was at 2000, the markets like to rest. Now silver, I had mentioned last week, a couple of weeks ago, I said, when you look at the gold hit its all-time high. Silver still about 50%, well, it was when we talked, below what was an all-time high of about $49.70, or so almost $50. My objective for silver was about 26, and the next was 30. And that was, I was looking out like till November or December. And we hit that last week, by the way. We hit $30 in silver, and silver still got a long way to go to catch up with gold. So, and one thing about silver, once it starts moving, it does move. So, but I will show you then, and also, by the way, I play platinum. It's used to be actually ahead of gold, but you can see we are way under half of the price of gold, and copper, they had been, again, there was the mining, the supply side, and then the demand for the houses. This is telling us something. So I will be watching the copper to see what's going to happen with the continuation. Was there a lot of short covering with copper? What was happening? So this is important to follow from the economic side of the things. And palladium works a lot with the industrial, the cars, electric cars, and that thing used to be, a couple of years ago, was the best performing really segment of the commodities. So this is something that I use. It's a linear regression line, and it is a proprietary indicator. But if you use Thinkorswim, I would really encourage you, especially if you are into numbers and probabilities. I really enjoy this. I use this even more than Bollinger Bands. And it's a similar idea. It's data mining in a sense. And this is the midline. And this goes back to 100. I use the 100 bars, and then I use the 30 bars. And this is really the mid bar, and then one standard deviation, and then two standard deviation. So I had my objective basically at 30 because of this line on a daily, and then I will show you on the monthly. I even mentioned we really needed rest in silver just because we were really overheated, and what happened was let me just make it a little, because I might be blocking that, so hope this will help. So here, as you can see, we went outside the two standard deviation, and that's when we basically decided to sell off and at least rest. So, and this is on a monthly basis. You can see from the monthly point of view, on 30 month, we are up slope, and we were way outside. But that's what silver does. When it moves, it really moves. And then this is the 100 monthly, and both of them, you can see the intersection. We were outside. So that's something that I thought is important to understand how this statistically works. Look where we were and we still got a lot of ways to catch up. One thing again, last week I mentioned, because it's been earnings seasons, and I hope in the last 2 weeks it's been hopefully educational about the expected moves, what the market makers do on option side. Even you're not familiar with options, or at least you don't invest in options, it gives you the guidance, at least for the future movement. So get familiar with it. Don't have to buy options, or especially sell options, but understand the market makers, this is their business. They do a lot of analysis, they do a lot of statistical work. So, and they want to make every penny that there is. So when they do, and I will show you, we've done it, I've shown you before how the option pane that you look at, and you can see the expected move based on volatility for the following week, for the next, for Friday. Those are not in vain. There are reasons. And last week I mentioned Apple obviously came and beat the numbers. They did have the 4-to-1 split. And one thing was that, you recall, I said the movement that the market makers were expecting, it was, I think it was like $12 or $10, or whatever it was that one standard deviation. This moved 2 standard deviation, and what happened was it moved more than $20. Usually what happens when upon earnings they're beaten by 2 standard deviations, then the price continues moving up. So just based on historical experience that I've had, and that's usually what happens is when there's an upside, and again, if it's within 1 standard deviation, it could go either way. So it could gap up, but it could go down. But if it's 2 standard deviation, usually it does like to continue. So here we have, from the chart's point of view, we have we broke above the as far as the resistance, and then we have just make it a little smaller, so you could see that last week was a pretty nice week. The same thing happened in Facebook. Facebook was about 1.5 standard deviation, so we kind of came at the low of the gap up, and then we continued. So these are just, I'm hoping this is a little learning lessons that you can follow up in your own analysis and see that if there wasn't an earning and if that was more than what was expected, usually the markets continue. All right, let's talk about the trade of the week. I have a very small amount because it's a continuation of, again, our earnings play that we are kind of ending it. So the earnings are coming to almost an end. The major ones are been out. So I'm going to continue with my earning expectations. And the company that I used was, again, might be blocking, so I want to show you that this was Activision. I played Disney and Activision. Again, the expected move, I looked at the 1 standard deviation, and I went 2 standard deviation, and I sold. In this case, I sold put and call on Activision right before the earnings were coming. So this is after facts, by the way. So this is what happened. So I sold. So I went kind of wide. I went more than 2 standard deviation up and 2 standard deviation down. I sold call of $100 on the Friday of Activision. I sold it right there, and I didn't wait till it again expire worthless. I bought them back at 1 cent. So it was it wasn't big profit, but it was good again. It's a journey that I look at. So it worked out, and I did the same thing. I went to sold the put up 74. I sold it here, and again I sold it at 1 or 2 cents, and I was out of that. I also did Disney. Disney was very much anticipated, and I like to emphasize what I've done with Disney because that's part of our strategy of the week. So with Disney, what happened was, again, with uh, expectations for the earnings, I went again like wings. I sold the put at 103, and I also sold the call at 130. So I went outside the expected move. So this one was successful. I did it very nicely. Again, I collected my 1 or 2 cents. I bought it back at 1 or 2 cents and 1 cent. No problems. That was easy because the Disney, the numbers were less worse than expected. So although the Mulan movie is not going to come on the screen, and Christopher Nolan it might be, so there was disappointment on that, and the Disney Plus and other things, but they were the stock actually moved up. So let's talk about follow up with that and investment strategy of the week, which what it is, again, it works with the option strategies using the expected movement and open interest. And what we call that, and I used to use this years ago, mostly on the monthly expirations. We call it Penny Friday, and what that means is now with all the weekly stocks, you can kind of use the options to become kind of if you did a binary betting to see, not all the time, it's all probability, most of the time, where that stock is going to end on that Friday, because it's all about these option market makers and how they do it. So what stock pinning means, you look at what is the most activity on the put side and the call side. And what the market makers try to do, they want to inflict as much pain on both sides. So what that means is, if you were buying, let's say, put on Disney, and somebody else was buying call on Disney, what they want to do, they want to put it in a price that they will collect the premium from both sides. So if that, let's say you bought, and I will show you an example, let's say you were betting that, oh, Disney's going to go to 130, I'm going to go buy a call at 130. So what will happen is, even if it hits that 130, remember, you paid a premium for that. So because you paid $1 or $2, even though it hit that 130, the person who wrote it or sold it, they're going to keep the premium. Because your goal was, your break even would have been 132, because it's $130 for a $1 or $2 premium you pay. So, or if you bought a put and you said it's going to go to 130. So the whole idea is, by pinning, what you could do, you could find out where is the most activity done. So an example would help you. There's another word for that, it's called max pain. And that's where, again, the job of the market is to take money away from you. So the markets, they try to find a way to find the price that they will see they're going to inflict the most pain. So just bear with me. I'm going to leave this slide so you can read this on your own. You can do a little more investigation. But I did this on purpose. I mentioned to you, I sold calls of Disney at 130. And that was my, I thought that would be it was my close to 2 standard deviation. So I covered 2 at 5 cents, but I have 3 left. Now what that means, and that options are done. So on Monday, I will be proud. I already own Disney. I bought it it was like 90 some dollars. But I'm gonna be a proud owner of 300 shares of Disney when Monday comes, because I still have 3 outstanding, oh, not proud owner, I'm sorry, I sold a call, so I have to deliver this, by the way, which is okay. So I'm gonna, hopefully if Disney goes down, I will buy it and then just deliver it. But the reason I want to just use it as an example to see what has happened So Disney's, you look at, this is called the volume, and this is the open interest. So there was a lot of activities done, and you can see the same thing in open interest and the volume. The most major thing was happening on that day, and it had the highest open interest. So basically, what the market makers were trying to do, they wanted to pin Disney at $130 to inflict pain on all these people who owned the, the options. And guess what happened? This is Disney's, this is the end of the day, Disney's closing price. So this isn't a strategy you could use. I mean, it has become kind of a lot of people are not using it. So it doesn't have the effect that it did like 5 years ago. I used to use it. It was beautiful on Apple. Apple was notorious to pin. Apple was good. Google was good. Facebook was sometimes. Expedia. Let's see what else. Expedia, Netscape. But those were like the really good ones. Apple was notorious. Now, again, a lot more people are being involved. But I just want to tell you, this is just an extra, hopefully a little more education. The whole idea is giving you, again, that edge. I know Sean has also used this before, if I'm not mistaken, but this is the website. It's called MaximumPain.com. You can go, and if you're looking for more information to see what is the best candidates, that's the time. All right. Now, I thought I'm going to mix the question of the week with going a little more in depth on what we did on Wednesday. And basically on Wednesday, recall if you joined us, it was more on when to sell our investments, not necessarily just stocks or options. It could be anything else. What formulas do we use? How we know it's the right time to get out. So there was a question is, how long should I hold my stocks? Now, you know, if you're Warren Buffett, obviously you have infinity. So a lot of large funds, they do. So because of the large capitals that they have. But if you're an individual that, well, you might need the money or you are looking for other opportunities, are you married to your position? Are you living with hope? Or is this really realistically analyzed stock? And yet, let's say if you own like some biotechnology, you know there's something going on. You've studied it, but nothing is happening. Well, how long? Would you wait 5 years? Would you like 10 years? So I thought this might be a timely way of going in more in depth and find out some of my reasoning or some of the general, you know, what I've learned over the years. When do I throw the towel, or where do I stay with my stocks? Because I think there's more longer term rewards that it will compensate me for my loss of opportunities. Again, being background in emerging markets, obviously I look at demographics, and sometimes it's very painful to be investing in countries that there's not much attention given, there's not much fund being invested, yet you know the value of it, so sometimes you just have to stick with it. But that's when you make sure it's a portion of your investments, not all of your investment, majority of it. So some of my reasons. So I go from the fundamental reasons, and I had mentioned too, when you are doing your trading planning, you do buy something, you want to have your reasons. You have to know why you're in this investment. So if the stock in the it has continuing with improving increased sales, the profit margins are expanding, there's a positive earning guidance, there's a good way of stock buybacks because they feel they have offering value, not this is a gimmick, you know, especially it happens unfortunately with the small cap stock sometimes. The CEO comes out and says, oh, you know, I love my company, has 1 million shares, and it becomes more of a PR. It has to be real reasons that the company feels their stock is undervalued and they cannot find other opportunities somewhere else. So that's why it is important. So if you see that, if there's some new products, I mean, this is like, we are in a COVID era. So with that, you can see some of these companies which are the head of their time, they had come up with products. Now you can see they are reaping the fruit of their labor. But also seasonality. You can see some of the companies, they work based on seasonality, and these are the times that you can forgive them sometimes. If I use, let's say, H&R Block, right? So this is an odd year now, but H&R Block, as you know, they get busy till April, so the numbers look good for the following earnings. But then, you know, it's summertime in October, or there's not a lot of activity. So basically you forgive them. Or it used to be in construction in Northeast. So seasonality plays a role. So this is the fundamental side. So as long as you have these, then you will stay. And especially if these were the reasons you purchased your holdings, your stocks, and there is no deteriorating factors, then you should stay. But on the other hand, if you got it based on more of a money management side, but also technical side, so these are some of the rules, the numbers rules, and I put time rules here that I like to apply, and I applied in my options, but also in stocks. So most of the time, I do encourage you to have this money management of take a portion of your profits, regardless. I like the 20-25% profit because that reduces my risk. So it is not only it's profitable in a sense of monetary rewards, but also I think psychologically it gives us that oomph, and it gives us that confidence that we made the right choice. We are glad we did this. So, but there's nothing wrong with making 20-25%, and just but the next question will be, if it was a breakout, what I mean by it was like a flat base, and I will explain it. I will show you some examples. And the stock moved up, and it moved up nicely. It went up 20% at no time. In this case, let's say 3 weeks. Then there's especially if there's a good volume, then there is a change of psychology and sentiment toward the stock. And it goes back to, let's say, that medical equipment that you knew something is going to come, the news are going to come eventually, and now the sales are going to go up. And if there was a new product, or it was a new catalyst, a new CEO or board member came in, that it's just going to make a big difference. So usually when it moves more than 20% in 3 weeks, then you should keep it for another 8 weeks, because it will be building another base maybe, and then it will move up. Now, usually when it builds that base and it starts moving up, it usually moves another 20%. So a lot of successful stocks, they usually build in 4 stages. So let's say it was flat and then it moved up 20%. It usually tries to go another 2 or 3. So hopefully this is helpful. But the 4th stage then is like the kind of tire. So I will be very watchful of what's going to happen next. And so I will be more cautious. Now, the real market leaders, they move from their base to break point to their peak. Usually takes about 12 to 18 months. So if you feel you're in a good investments and you don't know when to get out, look at the time. It could be more, I mean, but usually you got to give it time about 12 months or so. Now, I mentioned in our presentation on Wednesday, like as a futures trader, if I get in and let's say my objective, my profit loss is like $100 per contract. Let's say it's 20 points in Dow. And then I take again 20 points profit, 40 points profit, then 80, and then I just have a runner. If it doesn't move if it stays, let's say instead of 20 points, it moves like 5, 10, 5, 10. Then after 30 minutes, I'm done. I have a 30-minute threshold of patience. With stocks, obviously, it's different. You're doing it for the different reasons. So this is a good time putting if there's a lot of positive things going on. So give it about 18 months. Now, one warning sign will be that there's a great news, a good news comes out, and it's like, you would say, oh my God, I can't wait. Let's say it came after hours, and you're saying, oh, I'm going to be so rich. I can't believe, tomorrow it's going to double. And yet it fizzles out. So that's a warning sign. So that means all the news, and it's a time that you should start the distribution. Because why is that? Is because a lot of fund managers or institutions, maybe they had this inside information, or not inside, but they knew based on their analysis that, so what they do, they want to get out on the good news because that's a distribution for them. They cannot sell all at once. While the retail investors, all euphoric, they think this is the greatest things. So while they're jumping in, the institutions are jumping out. I emphasize this, the 20 and 50 and 200-day moving averages, right? I mentioned there's a few ways you can look at these, and I will show you some examples. I like to use, and I know that mutual funds and institutions use the two bars under the 50 or 200-day moving average. They need that confirmation. When it breaks down, then the algos do the same thing. They, again, fund managers, they look at it and they start distributing. And usually when it goes, 2 days goes down, comes back, hits its head against resistance, and then sells off. So that's one way. The other way using moving averages is could be crossing. I'd rather use it in a very short term rather than like 50 and 200 day. They call it, we'll look at it. So if it goes from top to, let's say the 50 crosses 200, that's the selling. That means the short term is going, that's called debt cross. And if it goes from bottom and the 50 days not crossing the 200, it's called golden cross. So, the books have written technical books. They think that's positive. I don't see it that way, but I will show you what I mean by that. But it is something that you could actually just take a look at it. The other things about moving averages, if it's flattening or the slope is changing, that tells you this move is tiring. So that's another thing. I don't really like the flat moving averages. That's why you use oscillators like stochastics, for instance, and RSI. So that's the time to look at this tiredness. Or you can use Bollinger Bands, and that, remember the narrow neck, we call it the squeeze. Maybe that's the time to just watch it to find out which way it's going to break out. The other thing is a lot of people use trend lines, support and resistance. Again, I use the 2 bars. If it breaks down, let's say it goes below the trend line, then it's time to get out. So, and the last but not least is the more of a money management. If you lost 8 to 10%, don't let it to become 20%, 30%, and then eventually you become very religious and pray every day that you can't wait for the markets to move up again. And don't be, religion has no place in investing in stocks. It's wonderful to be grateful and thankful, which I think is very important. But being spiritual during the investments, that's not the place to be. So this is what I meant by the flat base. So I want to give you an example. This is Xerox, which most of you know, especially people my age, that was the company, the coffee machine. And so basically what this, you can see, since March, we've been within a very short range, between $16 and $20. What we call this is called basing. What that means, or channeling, but basing, that means it's been back and forth within a price zone. So in this situation, you could see we would go up to $20. The sellers would come in. They think the worth is at 20, they're happy to sell it. Then it will go down to 16 and the buyers will come in. So really don't have any directions. All we know that there's the buyers and sellers agreed on a price between $16 and $20. We've talked about the ADX, and that was, if you recall, that was more of a trend indicator. And we like it to be over 20. At this time, as you can see, it's 8.85. So that means there's no trend. So without the trend, usually it's a 50-50 thing. So you don't want to, really, if you want to be in this stock, it's going to be more of a short term. You could play options, you could do condors, you could do vertical spreads maybe, but knowing that, well, it's not going to go over 20, or you can buy the stock and start selling it about 1950, 19. Or you can just be patient and say, well, you know what, either I'm going to be a day trader with this or swing trader for 2 weeks, or I put this on my watch list and I wait and I wait, and I'll see which way it's going to break out. And I look at the volume to make sure that breakout is valid. I watch the ADX to make sure there's a momentum and there's a trend change. I make sure if it's going up, it's based on green, it's going up. If it's going down, and let's say you want to sell it, so buy puts on it, then I make sure the red is the one that's going up. So the momentum is on the sell side. So that is called basing. Now, one example would be, and I went back, and this is Juniper, which is a communication company. So we went back to 2013. You can see this stock has been within this bracket for the last almost 7 years. And it's been going, just for simplicity, I say between 20 and 30, right? You're right halfway. There's good momentum on a monthly basis. So it looks good. So let's say if you want to be a long-term buyer, in the past, I found out these things on a weekly, I do the weekly analysis. This goes back 20 years ago. I would love to find flat basing stocks for long term, because once they break out, they really go. So you can, again, it could be even smaller than this. I would like to even half of it. So this is a potential, candidates to watch if it goes over 30. Now, on a daily basis, you can see this is called resistance line. Look how many times, it used to be support. We hit it here, 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 here. The more you hit, the tougher that the resistance is. That ceiling is really, they kept putting more cement and cement, or the glass. Once you break it, it's usually a good sign that it will continue, especially if you have a good high momentum, high volume. The momentum has changed, the green is up. So it just, again, my job is not giving you stock hints. This is not. It's more of a study of a behavior of a stock. As you can see, this is like a ascending triangle. You see this trend line is going up, has been a nice support for since March. Heavy resistance. So this is something I would encourage you to at least watch. And now, because you saw, for instance, what it was for the last 7 years, it's been really between 20 and 30, maybe you can justify and say, well, looks like at least, $30 will be resistance. So there could be another maybe 20%, 15 to 20% movement in this stock. So in that sense, this is something I would further investigate. It is communications, they've been in favor of the sector. And again, I look at the momentum, I see that stochastics are embedded. That means they're over 80. So that's good news. RSI is going up. This is the money flow. Money flow has been increasing, so there's money coming in. So And MACD, although it's getting a little flat, still in the positive. So this is just a food for thought, how to use, in this case, channeling, but like basing stock, and find out if that's a good candidate for further investigation. All right. The other one that I found like this week was like AES, right? So this is again ascending triangle and almost like a wedge, but you could see in this situation we were narrowing, and there was this resistance. We kept hitting it, and then we broke, and we actually then we started breaking above the 200-day moving average. Again, there's a momentum. I mean, that trend is getting stronger. There's a green. Just the food for thought. Just more investigation. Look at the fundamentals and other things. I'm just again just trying to give you some ideas how to analyze stocks and find opportunities. All of these, like you can see, this is from Finviz. They're free site. You can, basically use this. You can use stock charts if you don't have TradeStation or you don't have, for instance, I think we're showing what Ameritrade, Fidelity. This is free. So just a food for thought. You can see a nice volume breakout. I went back and I wanted to talk about moving averages and how you can use the moving averages again as a criteria to sell your position or not in this situation. And if I'm blocking, I just want to make sure I'm not blocking. So I minimize it so you can see it better. As you can see, this is the XRT, and XRT is the retail index, right? The retail sector ETF. We broke out in April above this 20-day moving average. So as a short term, as a swing trader, I use the 3, 8, and 21 actually. 21, these are the exponential moving averages. So I use those for mostly because of short term. This 20-day moving average plays a big role in the sense that becomes, once it breaks above it, becomes my support. So let's take a look at what happened. Every time we came and hit that 21-day moving average, we broke out. Let's use my 2-day, 2-bar confirmation. So if you don't mind, you can see it. So I'm gonna enlarge this so you can see it a little better. Okay. All right. So you can see right here. We closed below. We had a green bar, we went above it. We closed below, we went. So unfortunately, what happens is this breakout rule, and they call it false breakout. So a lot of, again, technicians, and you look at some of these financial services papers, and they say, well, could you buy confirmation 1 penny or 1 tick above? Well, look on the, or below for sell signal. So look how many times it could have been a false breakdown or false breakout. So what happens is, that's what I like, that 2-bar confirmation, knowing that this is for real. So the sellers are in. So in this case, again, what this means, that means that you are going to be in this till you get that confirmation. So hopefully that answers your question as far as when to sell. This week something interesting happened, and let me again, I hope I'm not blocking it. So let me look at this right around here. You see this blue line? This is your 50-day moving average, and this purple is, or whatever you call it, is your 200-day. We just crossed 50-day, moved above 200. In the technical books, as I mentioned before, they call it golden cross. That means now the short term is above the long term. I have a little problem with this because it's such a long, 200-day moving average on 50-day, there's still a long amount. I don't really follow that. I'd rather use like 3 and 8 or 8 and 21, because the markets are that way. There's a lot of movements. This is very lagging. So I don't find a lot of, you're probably going to read the financial news, they're going to say, oh, we had a golden cross. I usually think it's more of a lagging indicator. It's kind of too late to get in. I mean, the time would have been, for instance, you could see this is the 20-day crossing 50-day. That's a little better because although you cross it went up, it still came to support, but you would have bought it here. Well, there's some nice movement. But when look what happened on the selling. On the selling, the 20, let me just, again, we don't need the right side, just in case I'm blocking it. Look what happened. The 20-day crossed, the 20-day crossed the 50-day, and this is right around here. So although you missed, you should have said, oh, I could have sold it here. And again, if you would have followed the 2-bar break below 50, you would have probably sold right around here. But let's assume you sold it here. You still avoided all this drop. On the other hand, if you would have waited for the 50-day to cross the 200, which we call this dead cross, look where you would have sold it. This is where you would have sold it. And you would have missed this, and you would have missed all this, which is, so that's what I don't really, I'm a big proponent of a 50 and 200-day moving average crosses. That's my opinion. This happens in the Forex too, and I found out, especially in Forex, currencies, it doesn't work either. So anyway, just I thought I'll share that with you. Last but not least, I think, yeah, last but not least, on the QQQ. We talked, was it a couple of weeks ago? Again, I just look at 20, this is 21-day, how beautifully has been the support. Now, it was 2 or 3 weeks ago, we talked about this area. We broke down once, we bounced back. So it kept you, and again, let me show you where we are. It kept you in that position. So it allowed you to not panic, be patient, and you can apply this to all the stocks. And again, I like the 20 and 21-day. It's like an intermediate. So now, what is happening with QQQ? We're getting a little tired. So as I mentioned, the money is rotating, going to financials and energy and industrials. So I'll be watchful for that, but we're still comfortably above that. So this 21 days should be your barometer. All right. I hope it's helpful. Please let me know if it's if you find it informative. So the last few segments, we're going to talk about ETF of the week. ETF of the week is this week is, and the reason I use ETFs, it's just been so magnificent. Mutual funds were the only game in town. Even when you played like 401k, that's all there was. Now they're adding ETFs. The beauty of ETF is because it does, uses diversification of a mutual fund because it's the basket of funds, holdings like stocks or commodities, but it behaves like stocks. So you can actually buy and sell during the day. So you are not at the mercy of what's going to happen at 1 o'clock when they do all the reassessment of the final prices for all the holdings. So you can sell it and get in and get out easily, especially now with no commissions. It has made it a lot easier, although there was no transaction fee ETFs before, let's say with Fidelities and Schwabs and TD Ameritrades of the world. But it is wonderful to have the combination. So that's what I like the ETFs. It allows you to do things that it's more flexibility and more diversification. So the ETF I like to talk about is the IPO, and as the name indicates, is the initial public offering. Companies that they have come out recently. It goes back about 3 years or so. Usually, they have companies who are, the majority are like the last 2 years. You can see again it's a beautiful channel. This is called channel up or up moving channel. Look at this. So since March, April, we've been going up, hitting the top channel, coming down, going up, coming down, and right now we're in a kind of a critical point actually. Now, you would think that in a panic times, IPOs are not, don't have many IPOs because people, when there's uncertainty, there's not many IPOs are going to come into the market. So, and the old IPOs, how successful they be. Well, let's look at their holdings, and this might answer your question. Look at the holdings, the top 15 holdings that they have. And some of them, obviously, they have done magnificently. So you have Zoom Technology, which is their biggest holding. They have Uber, and then Pinduoduo, and then Moderna, and Pinterest, and then, NIO, Work. So that's one of the reasons, having one ETF, or like the Peloton, the sports and athletic equipment, Beyond Meat. So now you can see why this IPO like this has done so well. It looks a little tired, so I will watch it. So that's something that I thought it might be informative. All right, last but not least, again, this goes back to your option pane that you can see the expected move on every stock. Basically, this is for the following Friday. We've come from, the movement used to be 220, went down to 100. We've been, the volatility band is like narrowing. Although, again, because of the elections, when I look at the futures market on volatility, I see there's movement. But in the short term, the markets are, based on, we talk about put-call ratio, it's like contracting the volatility. So last week, the expected move was 71.48. And what that meant was the stocks could have either, S&P 500 would have either gone up 71.71 up, or they would go down 71.5. And that's 68% of the time we contain. Look what happened last week. We went just a little bit more than that. So we were outside the expected move. We were positive by 80 points. This week, we are a little even lower than that week. So what the market makers are thinking, the markets will move up or down 62 points. So why is it important? Because what happens, let's say you had a move on Monday, and I in past, like sometimes I've talked to a few of you in the past, and I would say, well, there's a turnaround Tuesday coming up. And one of my, again, the tools is like, if, let's say tomorrow morning, not tomorrow morning, on Monday morning, you see the market is up 100 points. Well, we've gone way beyond that expected move. So usually the markets like to go back to their normal range. So it's Monday, all the news came out. So if I am someone making assumptions in the sense that the probabilities, forget about futures markets. So let's say I want to, but let's say you do options, you probably would say Tuesday, there's a good chance that the markets will be down because we really stretched that rubber band. So if I had this big move up, or maybe even big move down, let's say we dropped 100 points, 120 points, I will be kind of inclined that maybe it's a good time to maybe to buy some weekly options. Or with the S&P, you could have like Wednesday. If it's on Monday, you can buy Wednesday's options, for instance, weekly options. So that's why this is important. Also, it allows you, if there's like, you look at the large cap companies in S&P, maybe at least if there's like, it's Tuesday or Wednesday, you're already up 150 points. Well, there is a reason to be maybe a little cautious. So anyway, that's what I think I find them helpful. So, and again, you have access to that in your Thinkorswim or TradeStation. These are available for you. So with that in mind, I want to open the forum for question and answers. If anyone has any questions, any comments. Before I do that, what I thought, if everyone is agreeing that this Wednesday, as I mentioned, I think it might be a good idea again, maybe work on how to have a good a journal, what is a trading plan, where should you start? Because if you have a good map and you can follow it, I think life becomes a lot more easier. It kind of gives you the timing of getting in something. What is your purpose? Are you an income investor? Are you a swing trader? Are you long-term investor? Once you have that clarity, then it makes it a lot easier psychologically to manage your risk. But when we are at the mercy of the news, at the mercy of hints, stock tips, then you really don't have, you really have moving targets. And it becomes actually frustrating because then you live from one day to another or from week to week. And that's the reason I think it's important to have a good plan. It could be a business, as I said, I'm hoping maybe I can give you some of like my own, what is a good journal, what do you need to write, but what is a good trading plan. But that was my thought on Wednesday. I will be very happy to hear what you have to say. The other thing is, the reason again, I'm so glad you're with me on Saturdays, hopefully these Wednesdays will be helpful too, is there's, if you would call it 10,000 hours of, you know, the 10,000 hour theory that if you practice or do something 10,000 hours, anything, playing violin or shooting the ball or whatever, you will be a master at it. And I think it has a that's Michael Gladwell's book, Outliers. And he said that the problem is, I mean, for some of you, the sports fan, I mean, I can shoot the ball 10,000 hours with the tip of my toes, but just keep shooting. That doesn't make me a good soccer player. So you have to have the right foundation and practice the right way, rather than just putting the hours and hours. And that's what I'm hoping by working together, we can kind of set up a fundamental basis that it builds it to a profitable journey, not just for tomorrow or a week from now, as I have mentioned, for many years to come. And hopefully you can transfer that to next generations, or to your children, or to your the younger generations, younger brothers or sisters. And this is the goal. This is the goal that hopefully it will be the right place to start, and hopefully it will continue to go to the right path. So with that in mind, I really appreciate your patience, and I'm open for, again, Sean, if you would like, you can unmute, and I will be all ears and like to answer any questions. Thank you, Sean.
Sure. I will stop the recording now.
Okay.
And then I think